Are you crypto curious? Already a crypto bro? Do you have FUD? Have you ever been wrecked? When moon, bruh? PTFD. Do you even lift, bro? The two most dangerous periods to dick around in the markets are at the peak and in the trough. The problem is, most people don't know they're in them until it's too late. In peak times, the sign is usually when your dumbest friend or a complete stranger gives you a stock tip. At the bottom of the market, though, there's a whole new crop of pushers that are far more dangerous, and that's who we're talking about today. So in this video, I'm going to go through the basics of crypto and the current investment landscape, but first, I'm going to tell you a story. A filthy story. A cautionary tale to show you that no matter how much you think you're invested and informed, you're not. I've been vocal for a year that if Trump was elected, he would run the economy into the ground. Not just because he's uncertainty personified, but because he would tear apart the regulatory framework of markets and industry. He'd blow up social safety nets and treat the Treasury like a speculative piggy bank. I mean, the guy wants to create a sovereign wealth fund so that he can personally direct its investments without oversight. Imagine the world's biggest grifter in charge of the world's biggest piggy bank. Well, elections and actions have consequences, and here we are. The precipice of a recession, which means we can actually spot the moment that we head into the trough. And that means the speculative vultures will be out in full force and tempting you with serious crypto FOMO. I mean, Bitcoin was over 100 already this year, and it's starting to rebound. Could be time to buy, or not. Just don't miss out. Beware the speculator in times like these.
UNFTR.
It's said that Papa Joe Kennedy got rich by pre-selling the 29 crash on insider trading, a practice that he was actually quite often accused of. His punishment? They made him the head of the SEC. Some of the biggest trading houses in the stock market used to run schemes called front-running, where they would make personal trades before inputting trades from their institutional clients that were big enough to move the market. Hey, did you know that it's illegal to trade onions as a commodity? That's because in 1955, commodity traders named Vincent Kasuga and Sam Siegel hatched a scheme to corner 98% of the market by physically storing onions and then running up the price and dumping them. So Eisenhower made it illegal to trade onions in the Onions Futures Act of 1958. Hedge funds and investment banks built out fiber optic networks to get and trade information faster using algorithms, generating a form of electronic arbitrage by always being milliseconds ahead of market moves. Point being, you're not in charge. There's always someone bigger, richer, faster, and more reckless than you. And they've got money to spare and an offshore account to backstop their bullshit. And they're going to get rich off of you and in spite of you. Now, we all know the big stories, and they're all the same. From onions to mortgage-backed securities, Enron to Bernie Madoff. Stories that are about schemes so good to be true because they were. They were just built on speculative lies. But there's another story that really no one talks about. One that demonstrates how far these things go, how easy it is for fat cats to manipulate the system, and how easy it is for them to get away with it. In the summer of 2008, the financial world was just beginning to melt down. The housing bubble was ready to pop. The entire global economy was in deep, deep trouble, but only a few people understood how bad things were about to get. The liquidity crisis had begun, and Wall Street needed money, and it needed it fast. At the time, the head of Morgan Stanley was a guy named John Mack, and Mack was more than a wealthy Wall Street executive. He was an oil man, in every sense of the word. I'll explain. See, under Mack, Morgan Stanley amassed a formidable group of companies involved in every aspect of oil, from refineries to home heating oil, a move that partly enabled him to navigate through a storm that brought some of the biggest American investment banks to their knees. And the whole world picked up the tab. By exploiting regulatory loopholes and throwing caution and conscience to the wind, Morgan Stanley, with Goldman Sachs right on its heels, artificially thrust oil prices to record levels. They didn't call him Mack the Knife for nothing. Max Morgan Stanley went on an aggressive oil buying spree, but not necessarily the kind that you might expect. In 2006, Morgan's resident oil expert announced that integrated oil equities were, quote, 15% undervalued. And in a research report, he wrote that, quote, independent refining and marketing remains the largest sector bet in the global model energy portfolio, end quote. So soon after that announcement, Morgan Stanley acquired TransMontaigne and its subsidiaries, a $500 million group of companies operating in the refined petroleum business. How convenient. Just days after their analyst decides that this portion of the industry is looking up, Morgan Stanley gets into the oil business and buys an oil terminal company. But it didn't just take a few days to conceive of and work out the deal. This had to be a long-planned, well-thought-out takeover, one that worked for the great benefit of Morgan Stanley's future oil plans, as TransMontaigne at the time controlled 1/3 of the nation's oil terminal storage capacity. So Morgan's investments in the oil business continued aggressively over the next year into the far corners of the industry. And in short order, it closed the circle of the supply chain by acquiring Heidmar, a shipping company that owned 120 massive oil tankers, also including various stakes in foreign-based energy supply companies. It even snagged a contract from the U.S. Department of Energy to store 750,000 barrels of home heating oil at its corporately owned terminal in New Haven, Connecticut. Morgan Stanley, which was at the time the largest trader in oil futures, was now also a serious international oil company. So in 2008, Morgan's analyst, a guy named Doug Terreson, said that oil would settle around $95 a barrel for the remainder of 2008. Moreover, he concluded that oil would retreat thereafter to around $83 a barrel in 2009. That would be his last forecast for Morgan Stanley. 2 short months later, Dow Jones Newswires reported that the analyst had been ousted in a round of layoffs. And 2 weeks after that, their head of global economics and chief U.S. economist, a guy named Richard Berner, issued a statement saying that crude oil could easily reach $150 a barrel during what was going to be the Great Recession, mind you, right? So this forecast set off a round of speculative fervor never before seen in the market, and probably never to be seen again. Goldman Sachs immediately followed suit by forecasting oil could roar beyond 150, saying it could reach 200. 200 a barrel. Oil prices were off to the races, with the investment banks in full lobbying mode while pointing the finger at China and India. Remember, this is smack dab in the middle of what we now know was the worst liquidity crisis in banking history, and what we know is the Great Recession. For a brief moment, oil did indeed hit $147 a barrel, a record never before reached and likely never again. Congress finally stepped in to ask what the fuck is going on, and former regulators and traders themselves copped to the con and said the entire thing was just cooked up. It was pure greed, pure speculation, and nobody got in trouble. But why? That's the question here. Why was it so out of control? Why oil? What happened to the so-called perfectly functioning, self-policing free markets? Well, timing matters here. Remember, it's 2008. So let's say for a moment that you run Morgan Stanley, and you know what most of America is about to discover. The bubble's going to burst. Not to mention that over the past few years, you might have made a couple bad deals. Okay, more than a couple, but not as many as your friends over at Bear Stearns and Lehman Brothers. Nevertheless, you need cash, and you need it fast. Now, thankfully, you have remarkable control over the price of oil, because you can just say what it's going to be. All you have to do is say the words, and the markets will follow. Pick a number, 100, 125, 150, 200, whatever helps you close the gap and fill the coffers. And it's no small matter of convenience that you also own 1/3 of the oil storage capacity in the country and control several global shipping routes. What's more, the government just handed you a contract to store 750,000 barrels of home heating oil for the northeastern United States. And you founded and are still an owner of a public exchange that handles energy trades that no one can really see. Win, 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 win. Hey, don't forget to like the video and hit the bell to be notified of any new drops. And remember, you can sign up for our free weekly newsletter at UNFTR.com. It's the fastest growing progressive newsletter in the country, covering news stories you might have missed, an economic chart of the week, book and podcast recommendations, and an original essay. Ray Dalio, founder of the world's biggest hedge fund, said we might be heading for a recession that could potentially be worse than the 2008 recession. Now, Dalio's concerns carry some weight because he issued a similar warning in 2007, just before the Great Recession. The current precarious position stems largely from President Trump's aggressive pursuit of global trade tariffs, which Dalio characterizes as causing a breaking down of the monetary system. This economic brinksmanship is even pressuring the US dollar, and markets are betting that recession odds are between 40 and 60%. So in these kind of environments, investors typically flee to traditional safe harbors: Treasury bonds, golds, and other stable assets with reliable returns and historical resilience during downturns. Yet paradoxically, these periods also witness capital flowing into highly speculative investments, including foreign currencies and developing economies, and increasingly, cryptocurrencies. Now, our last video unpacked the correlations between the US dollar and the 10-year Treasury, which split recently and caused some serious panic. Now, this seemingly contradictory behavior stems from several psychological and financial factors. See, some investors seek to preserve wealth through proven safe havens, while others chase outsized returns to compensate for anticipated losses everywhere else in their portfolios. The currency markets, both traditional and digital, become battlegrounds where these opposing investment philosophies collide, and nowhere is it more apparent and prevalent than in the crypto markets. The cryptocurrency ecosystem has evolved dramatically since Bitcoin's inception, sprouting various specialized digital assets such as stablecoins, meme coins, exchange coins, and payment coins. Now, stablecoins are designed to maintain consistent value by pegging to external assets like the US dollar, gold, or other financial instruments. These coins are there to reduce volatility, making them suitable for everyday transactions. Meme coins are just bullshit vehicles inspired by internet jokes and trades with little inherent utility beyond community engagement and speculation. Their value derives primarily from social media hype and viral trends rather than fundamentals. These coins, like Elon's ridiculous Dogecoin, are characterized by extreme volatility and risk, though some have achieved some significant valuations through celebrity endorsements. Now, exchange coins are issued by cryptocurrency exchanges themselves to provide utility within their platforms. But Bitcoin stands apart. It's a payment currency, or a payment coin, whose primary purpose is facilitating decentralized peer-to-peer value transfers without intermediaries, so payments without banks. Unlike stablecoins, it isn't pegged to any asset, though. Unlike meme coins, it wasn't created for entertainment, and unlike exchange coins, it wasn't issued by a trading platform. Now, in regulatory terms, Bitcoin is often classified as a commodity in the United States, similar to gold due to its scarcity and use as a store of value, but just as easy to manipulate theoretically by the institutional players as crude oil. You see, despite increasing mainstream acceptance, cryptocurrencies are fundamentally speculative assets. Unlike stocks representing ownership in companies that produce goods or services, or bonds that are backed by government or corporate earning power, cryptocurrencies exist in a realm of pure belief. Their value derives exclusively from the collective agreement that they should have value, a circular reasoning that becomes particularly problematic in economic crises. So look, all of this is not to suggest that cryptocurrency infrastructure hasn't matured significantly, because it has. There's enhanced exchange security, greater regulatory oversight, and all of that, but there's still substantial risks that these kind of investments face that traditional investments don't. So like smart contract vulnerabilities continue to expose billions to potential exploitation. Exchange hacks, even though they're less frequent than they used to be, still occur with sobering regularity. The cryptocurrency space also remains plagued by market manipulation tactics long banned in traditional markets, like pump and dump schemes, wash trading, various forms of front running like we talked about before. Regulatory frameworks are developing kind of unevenly across jurisdictions, which also creates uncertainty and enforcement gaps that sophisticated bad actors are able to exploit. So it should be said that both sides of the aisle have accepted disgusting amounts of campaign contributions from the crypto industry. Even the Biden administration had loosened its stance toward crypto as a commodity, though officials there were far more skeptical generally than the Trump team. But with Trump now in office, all bets are off. Trump's 2.0 administration is staffed with very vocal proponents of the industry from the top down. President Trump himself has suddenly become a vocal advocate, establishing a strategic Bitcoin reserve and signing executive orders supporting the entire industry. His administration features David Sachs as a crypto and AI czar, chairing the president's working group on digital asset markets, Bo Hines leading crypto policy efforts, Paul Atkins recently confirmed as SEC chair, all known for strongly pro-crypto positions. The administration has already dismantled enforcement-heavy regulatory approaches, disbanded dedicated crypto enforcement units, and shifted focus away from industry oversight. This political environment, while celebrated by crypto enthusiasts, creates a dangerous regulatory vacuum precisely when the market volatility demands more vigilance, not less. While there are individual investors, early crypto adopters, day traders, and normies with wallets and experience, the fastest growing investor segment is institutional. Current estimates suggest that institutions, governments, and corporations collectively hold nearly 15% of the total Bitcoin supply, with $108 billion allocated to Bitcoin ETFs alone. Nearly half of the traditional hedge funds now maintain cryptocurrency exposure, a substantial increase from 29% in 2023. The trend shows no sign of slowing. A January 25 survey this year found that 86% of institutional investors either have cryptocurrency exposure or plan to allocate in 2025, with 59% intending to commit over 5% of their assets under management to cryptocurrencies. American institutions and hedge funds lead this allocation surge. The institutional presence, coupled with an administration populated by crypto enthusiasts, creates a perfect storm of risks. And hedge funds, by the way, which account for nearly half of institutional crypto exposure, typically operate through leverage, using borrowed capital to amplify potential returns. And this amplification works both ways, potentially accelerating market crashes when positions need unwinding during economic stress. With regulatory guardrails weakening and institutional leverage growing, the systemic risks have never been greater. Joe Kennedy, Vincent Kasuga, Bernie Madoff, John Mack, they'd be moving their money offshore right now. They'd also be buying U.S. treasuries and holding cash. But they'd be telling you to buy Bitcoin. They wouldn't be betting on it themselves, though. They'd be betting on you to bet on it, because they would have staked a position on the downside, just like John Mack did with crude oil. Now, he didn't just make it on the way up, he made it on the way down as well, because he was behind it all along. Now look, if you mine Bitcoin, have at it. You're Daniel Plainview at the bottom of the well that he dug by himself. But I don't care if it's oil, currency, crypto, or onions. Doesn't matter to the speculators, because they're not betting on the instrument. They're betting on you. Be careful out there. Here endeth the lesson.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Started a